All right, we got a couple more folks sign in, so we're going to go ahead and get started today. It's about 5 after. So again, for those you can see me on the screen, my name is Pat Walsh. I'm a partner here in Oxford with Eric, who's on the screen now as well. Appreciate everybody being here today to answer all your questions about the craziness going on in the world of the markets today. So appreciate those. Special thanks to those who have submitted some questions beforehand. I've got those all captured, and we'll be sure to cover as many of those as we possibly can. As far as any additional questions that you have, again, for folks that have been on the call for a while, you've heard me say this a few times, but you can pull up a chat box on the right side of your screen by hovering over the middle where you probably see Eric's face right now, maybe myself since I'm the one talking. There's a little chat bubble. You click on that button, it'll open the chat on the right side of your screen, and you can fill in whatever question you might have for Eric or myself. I'll be moderating those throughout the day today, and we'll, again, try to get as many answered as we possibly can. So if anybody has any questions, let us know. Otherwise, we'll go ahead and get started. Eric, the floor is yours.
All right, Pat, thank you very much. As I know Pat already mentioned some of this, just some general housekeeping things. This is our very first time using this technology to try to host a webinar like this. So we've been testing it some this week. Everything seems to be working just fine, but should you run into any issues, try that chat box on the side. I think Pat may have mentioned this already, but everything that we cover today, this whole webinar is being recorded. And so playback will be available. We haven't quite determined where we're going to host that just yet, if it'll be posted on our website or where that will be. So just want to let you all know that that was, anything it said, you'll be able to recapture this later. So with that, and barring any technical difficulties, I just want to take this moment to thank everyone for making time to hop onto a call like this. Obviously, the times we're going through right now, while not completely unprecedented, at the same time, we haven't seen anything quite like this in about 100 years since the Spanish flu in 1918. And that has a lot of implications, obviously, from a personal standpoint. I know we're all very worried about our loved ones and everyone's health. And so there are a number of pretty amazing things going on right now in terms of everyone sheltering in place. And so you may be in a location where you're dealing with some of that right now. So the things we'll cover today are obviously going to be a little more on the focus on the investment economic side. I don't want to at all, make light of the tremendous impact that this virus is having on the world right now. We're obviously not scientists and we're not physicians, so we won't be able to cover a lot in detail there. But we have put out some research papers from our end and distributed some of those to the extent that someone's got something insightful on that too. So just there's the background real quick. Again, thank you so much for making time for this. And with that, Pat, if you would steer us to the first question, let's get started.
We'll do it. One last thing, just a reminder, and again, some folks have heard this already. From a speaking standpoint, it will just be Eric and myself. I'll be reading the questions out loud, allowing Eric time to respond, and then we'll move on to the next question. So I'm not able to respond back to you within the chat, and everybody else, as far as attendees go, is muted. So if you have a question, feel free to type it in the chat box, and we'll get it addressed one way or the other. So with that, Eric, the first question we had is just kind of an overall overview. So what's your opinion on everything going on, between the markets and the government? Are we overreacting? Are we underreacting? And how do you see this whole thing playing out over the next couple months?
So now I have to get the crystal ball out immediately and play fortune teller. Obviously you're not going to find fault and whether it's national, state, local government, trying to do all they can to literally save lives. And so I think the things that have been done, you're starting to see some results from this. Wuhan in China, where this thing originated, they've actually made some pretty good progress, not having new cases pop up at this point. You get into a lot of issues with obviously restricting people's freedoms, and we're all kind of grappling with that. And hopefully everyone's getting along well with their families and when they're sheltered together in a house. So there's that response, and I think probably the root of this question is probably getting at, from an economic standpoint, is this the right thing to do? And that's a tougher one to answer. Let's be honest, you can't disrupt the economy so dramatically, so quickly, and not expect there to be some pretty serious after effects from that. So the new unemployment claims came out yesterday. In a typical month lately, that's been 50, 80,000 in a week maybe. It was 3.2 million new jobless claims this week. It's the largest one week report that's ever come out. but it shouldn't be surprising. You can't shut down restaurants and name all the other services out there without that having an effect. So good news is the Senate has put forward legislation at a 96-0 vote that is aimed at trying to inject some very, very needed financial support out into the system, both for individuals, extended unemployment benefits, and small businesses have a $350 billion slice of that, and then you got large businesses as well. So $2 trillion is a lot. They're trying to get it out there quickly, and I think those things will help mitigate some of the economic damage that's being done. But let's face it, there will be economic damage done from this. How that affects the stock market, typically over the long haul, the stock market's a pretty efficient, forward-looking thing. But as we've seen in recent weeks, in the short term, it can be an absolute madhouse. And I think there's been some overreaction in the stock market. But at the same time, the market's trying to gauge what will the effect be on the economy. We may already be in recession right now, and the numbers just aren't playing it out yet. But I think it's very likely that the second quarter, the entire second quarter for the United States, we're probably looking at very, very serious economic contraction. Whether or not that will pull the stock market down more, I would be hopeful that that will not be the case. And I apologize, folks. I've got technology bothering me here. Sorry about that. So sorry. Just literally threw it in the trash can. Anyway, hopefully it'll be quiet down there. So we'll see some effects from that. My hope is that the market has already worked through some of those things and realizes, hey, it's going to be some short-term pain with this. It might be a quarter. It might be a couple of quarters. But should we get things back on track, then you're going to see people getting back to work. You're going to see massive buildups of inventory again. So I think those things will probably point to some accelerated growth in the latter half of the year. It's just going to be a little painful here in the short term.
All right, makes sense. Thank you for that. Next question, and kind of in light of the recent changes in the market, we've had several questions about just changes to the portfolio. Obviously, different people's situations are different, but have a number of questions around, is there any portfolio restructuring to be done? What changes can we make to the portfolio? Should I sell some things? We had somebody write in that they've got different types of investments, stocks, bonds, closed-end funds, things like that. What would your recommendation be, or your reaction to those questions about what can be done to the portfolio? Should nothing be done in a time like this?
Yeah, this one, you get a little bit of trouble trying to give out. That's a very specific question, which is it's an important one, and multiple people, I'm sure, have asked that one. You get in a little bit of trouble trying to give out specific advice in a situation where someone may have very different goals and needs from the portfolio than someone else on the call. And also, to the extent that someone's already a current client of ours, they may have received some different advice and preparation going into this type of a crisis. So I apologize if what I say is not helpful to some folks. We have a very strong philosophy at Oxford that portfolios are built in anticipation of volatility, not in reaction to it. And obviously, there's been massive volatility here in recent weeks, and that's a very scary thing, a very concerning thing, especially to the extent that if someone sees that and says, "My gosh, this plan that I've devised to retire at this age, to put my kids through school, whatever those long-range plans are, am I still okay? Does this type of a 30% drop, does this really wreck the path that I'm on?" And I think it really is a deeper conversation about if you still have those goals, and if you'd already put a plan in place for achieving those goals, that plan should have been reflective of the realities of the stock market, which is, on average, once every 5 years, we do get a massive correction, and it usually averages out to about a 30% drop when these happen. So even though each one of these events feels very different than whatever the last crisis was, the reality is they share quite a bit in common. About once every 5 years, 30% drop. The causes are different from one time to the next, but so far, this one, and we'll see where it goes from here, so far, it has not been an exceptionally unusual type of drop. It was steep, it was fast. And then you have these things like we've had in the last 3 days where it's up 21% off the bottom. That's a lot of volatility, I get that. So assuming you're working with someone or doing it on your own and you've built a good plan and your goals haven't changed and you had the right investment portfolio set up to achieve those goals, the long answer is no, you should not have to be making any changes to your portfolio at this time.
All right. Next question, it's actually a very specific question about a certain topic, but I think it's a good one. So given that the stock market is down, what is the best way to make a charitable donation during these times?
Once again, I think that's a really specific question. Depends on what the funding strategy has been for your charitable donations in the past. Are you doing those from cash that you have had left over and then just literally writing checks? Are you doing donations of appreciated stock? Whether that's a different tax strategy there. So I think that's one that's probably pretty specific to each person's situation. Did the person write in any more detail than that?
No, I think there's just different ways to do it between, using some of the IRA strategies versus some of the stock strategies. And maybe there's one that's better than the other when there's a period of volatility or a downward market where we are right now.
I think, I'll take it from I'll just make the assumption that someone's talking about donating shares of stock. And we have a number of clients that, we'll do donations to charity, to their churches, and they'll do that through a funding strategy of taking, highly appreciated shares of stock that have grown in value over time and have a big tax overhang with them, a lot of capital gains taxes. It's a really neat trick to be able to say, hey, I'm going to give the church this amount of money, and all the capital gains are just really disappear. So the donor gets a nice tax break for making that contribution. The church is a not-for-profit organization, doesn't pay any taxes, so the capital gains associated with those shares go away. Obviously, in a time when the markets are down, if you were going to make a gift at this moment, you're doing it with shares of stock, just understand you're making a smaller gift than you could have made a month ago, and probably a smaller gift than you should be able to make sometime here in the future. So it's essentially the same idea as, should I sell out of the market at this time? And when things are at a fire sale, I would pretty strongly urge someone not to be getting rid of shares of stock at this time.
All right, makes sense. Thank you. Next question, again, it's sort of topic related, but I think it's a good question. So somebody wrote in, they're in the process of buying a new house and selling their current one. So what are your thoughts on how the real estate market might react to what's going on right now?
Did I write this question?
No, it's good.
That one hits right at home, because we're literally going through that ourselves right now. And when the month began and we were putting an offer in, we didn't really expect the virus thing to hit. So sorry, I got myself off track. The question specifically was what? What's going to happen in the housing market?
Yeah. What do you expect the effect on the housing market to be, or the real estate market in general to be, over the next several months as this whole thing gets sorted out?
It's been interesting when if you roll it back, let's say 6 or 8 weeks, really before the virus was making itself so prevalent here in the United States, interest rates had actually gone down, and so there was a huge spike up in refi activity with homes out there, and the housing market coming out of winter is always a little bit slower. So I think things were just starting to pick up, and some realtors had told me that the usual spring fall was actually happening earlier because of interest rates, really driving some activity. We are literally right in the middle of this right now, and depending on what part of the country you live in, you may or may not be under restrictions. I happen to live in Denver. We've got clients obviously in a lot of different places, and here in Denver, it's the realtors have gotten clearance to still do their jobs. I don't know how much traffic is out there. That's obviously a very real thing right now. It just might vary a little bit by area. Longer term effects, that's a really interesting question. I mean, I tend to be a bit of an optimist. I have a lot of faith in the ability of our scientists and our companies to attack this thing and develop new therapies and roll those things out quickly, because we have far and away the greatest distribution logistics system on the planet and incredibly innovative people. So I think we will get past this thing in a reasonable time frame. And if that were to be the case, then I think you're going to have some pent-up demand with people saying, hey, I was planning on doing something in the housing market back in the spring, but I had to put it all on hold. And so when this thing looks like it's letting up, you might see a pretty strong response. Interest rates have remained low, so and that's probably going to be the case because between the U.S. Treasury Department and the Fed, and then also with Congress approving $2 trillion of help into the economy, you're not going to see interest rates going up. They're going to stay low, and that should really help with getting people active in housing again. This is, and the question wasn't asked, but I'll go ahead and try to tie this together. If you roll the clock back to 2008 and 2009, and there are any there's several different competing or complementary theories of what happened back then that caused the stock market rout. The housing market was very, very clearly overheated back then. I mean, the difference between getting a loan nowadays versus 11 or 12 years ago is night and day. The documentation that's needed is overly difficult. I'm experiencing that myself right now. Just almost silly how many things you have to, hoops you have to jump through, even though there's no question whatsoever about your creditworthiness. It's just a lot of administrative stuff. And that grew out of the fact that it was the Wild West 10 to 12 years ago. Anybody could get a loan. There was a lot of fraud that went on back then. So anyway, a lot of those things worked out of the system. So I'm not at all concerned that this is somehow like the last one 11, 12 years ago from a real estate perspective. Not at all.
Okay. All right. Next question is, my goal is to retire in 2 to 3 years. How might this recent decline affect that? And there's something I could have done in advance of the volatility to make sure that my plan stays on track.
Yeah, that's another one. Again, trying to give out specific advice on the one situation. I'll just fall back on some philosophical things that we preach on a regular basis at Oxford. We have this big thing with the number 5. So if you've seen any of our materials, you're probably familiar with some of that. And if someone came to us today, or a month ago or a year ago, whenever, and said, hey, I'm thinking about retiring, the first question we ask really is, well, when do you see that taking place? And for us, it's really important to understand if someone is within 5 years of when they think they're going to retire, then that's a very specific zone to be in, where it's not just running the numbers to say, hey, does it look like I'm on track? It is also about structuring the portfolio to be ready so that 5 years from now, even if you retire into the mouth of a very bad bear market, you still already have the capital set aside that you're going to need to live on to get through a meltdown like that. And so this question was specific to 2 or 3 years. I have to know what this person has done up to this point. I'd like to say that for someone, and we've had this happen, when we had folks who were nearing retirement either by choice or by a corporate downsizing back in 2007. No one could have seen at that time. By the way, October of 2007 was the prior market peak before that happened. At that time, no one could have foreseen that the housing mess was going to take place and what kind of effect that was going to have, and the Lehman Brothers going out of business. So if you had built a portfolio knowing that something like that could happen, then you should have been fine. So not knowing this person's specific situation, I can't really say, but that's how we would have handled something like that.
Okay. Next question, let's see. Actually getting at getting that idea of stability bucket and growth bucket and building up that protection in advance, and dealing with market volatility in advance instead of again reacting to it. For those that don't know, our current clients have this concept of stability versus growth. We have a certain amount of dollars outside the market to protect for their upcoming withdrawals, and then the rest is invested for long-term growth. So we had a question from a current client of what formula do we use, or what formula is used to determine when to refill that stability bucket when times are good versus not refilling it when times are bad like they are right now.
Okay. And Pat, I'll probably wander a bit. If you can pull me back, I'll get to that. I will answer that question, but I need to set the stage first. And this ties in a little bit about what we were discussing in the last person's question. Hey, I'm 2 or 3 years from retirement. Should I be making changes to my portfolio? When I say that 5-year thing is such an important concept for us, we would literally take whatever that person is projected to withdraw from the portfolio in the next 5 years. We would take that pile of money and we would set that aside into something we call a stability bucket. So you're talking about money market funds, bank CDs, very, very short-term, government bond instruments. We just wouldn't take risk with that type of stuff because we know the person's going to need that money to live on, and it could be that they need to live on that money in the middle of a really bad market correction. And so we preach this 5-year idea because we want to make sure we've got that reserve built up. If you go back and look at history so far, there has never been a time where you would have had the stock market go down more than 3 years in a row. And that was 2000, 2001, and 2002. So if you've gone into that type of situation with 5 years of your spending set aside, what that does is that allows you the freedom to say, hey, this is bad. 2000 was bad, 2001 was bad, and then just when you think you're getting out of it, here comes 2002. And it was the worst of the three. When you see those things happen, while they're scary to go through, you already know where your checks are coming from when you're making those withdrawals. And so even in that situation, we would not have had a need to try to refill someone's the money spent from the stability bucket, because while we wouldn't want to sell stocks at fire sale prices to do that, we want to already have those gains ready and harvested before the crisis happened. And so when someone, if we make the assumption that they have done that part appropriately, then let's apply it to the situation right now. So if you're going into this and you have 5 years of spending set aside, and then it's time to take a look at, hey, I've spent a year's worth of my stability. I only have 4 years left now. What should I be doing? We actually have a very formulaic approach that we take in determining whether or not stocks are appropriately valued or not, and should we sell them at current prices in order to fill someone's stability bucket. I'm not going to bore you with all the details on it, but we take a look at historically how far away are stocks from historical normal valuations. And even then, we've got some tolerances saying, until it gets to be here, we're just, we're not feeling like we should be letting the stocks go at these low prices. Our investment committee just met this week, and we had this very conversation, and we made the decision to say that at this time, we don't think it would be a good idea to be refilling stability buckets, because we just don't think stocks are appropriately valued. They are quite a bit on sale right now. And so you wouldn't want to let those things go until prices have recovered a little bit.
Okay.
Did I circle back to it without being prompted?
You did. I think you answered the question appropriately. So speaking of that stability bucket, growth bucket concept, or some folks have wrote in that they've got some cash on the sidelines they might have at a bank, or it's been rolling over in CDs at their local bank. So should folks be looking to invest any idle cash reserve back into the market with the idea that they would be buying low, and that those are going to go back up? And then kind of a follow-up to that is, if somebody did have some cash in the bank or something like that, how low would you take that cash in the bank, or what's an appropriate level of emergency fund, things like that, to hold back in reserve if you were to jump in and try to buy some stocks while they're on sale?
Yeah, this is interesting. We do some idea sharing, networking with other advisory firms as well, and we've got some some nice groups that we're members of, and there are opportunities to kind of share some thinking just kind of across the country about how people are viewing some of these things. And I think within our own client base, I have been surprised, and I guess the word pleasantly surprised is the right way to say it, by the number of folks who have said, hey, these things, this isn't going to last. I've got some idle cash. Should I put it to work? And I think the answer to that really depends upon where those dollars are coming from. If you've got some mad money that's sitting in the bank and really didn't have any specific purpose for it, it's not a reserve fund. It's not, it's not money you're going to be needing. And I'm not a fan of trying to time markets, but I would say anytime you see something go on sale for 30% off, it might go to 50% off pretty soon, but 30% off is a pretty good discount. And if you have idle cash that's not committed to something else, it might be a nice opportunity. If it's dollars, though, that you think you actually might need to be spending, whether it's down payment on a house, whether it's, hey, I'm retired and this is part of my withdrawal strategy, my advice would be to not put those dollars to work, even though it's quite tempting to try to do that at what appears to be a pretty big discount. I don't know if I'll send this out after this call or not. I just worked it up this morning, and I need to make sure it's factual and compliant. But I went back and looked at the last meltdown, 2008, 2009, and looked at the pattern of these upswings and downswings, because so far on this one, we've had a very steep drop that happened faster than any decline has ever taken place before. I don't mean to sound alarming with that. It's just those are the facts. At the same time, we've had the last 3 days where we've jumped up 21%, and that has also been a very historic climb up. You have to go back to the 1930s to see such a rapid rise from a low point. But if you look at the pattern from 08 and 09 and say, geez, I bet nothing like that has ever happened before, it actually happened several times in 2008, 2009, just not as rapidly. And so I think you have to be a little bit cautious, saying, gosh, it's gone up 21%. I guess this is over. We should probably buy, hurry up and buy before we miss out on something. I don't think I would term it that way. We could very easily be looking at a very serious, a complicated series of ups and downs before we're really in the clear on it. And so we find that it's very difficult and probably foolish to try to time markets and make predictions about those things. We just know that if you take the long view of history, that these things do work themselves out and provide nice returns over time. Actually, we have a piece going out Monday to our clients and anyone on this call. We can certainly get you a copy of it. We've got a piece going out on Monday that shows what has happened on the last 3 major downturns. So the stock market crashed in '87, the dot-com meltdown in the late 99 and into 2000s, and then of course the 2008, 2009. If you step back and look at how things have done since those events, you're looking at really strong positive returns on an annualized basis. So if you draw the timeline out long enough, you get to see that these things do pass, and you do get rewarded for being patient and staying and sticking with it. But trying to time it and saying now is the bottom, or maybe this is it, timing doesn't work. There's some that say it does, but it doesn't work.
All right. Let's see. Next question is, actually, this is kind of a planning question and an investment question, but it says, how does Oxford view risk/risk tolerance? Is there any reason to change mine or revisit mine in light of the recent events that are a little bit out of the ordinary?
You know, this is there's a lot of debate going on in our profession about, even the word risk seems simple enough. I think when you, if you were just to do a survey of people and say, what does risk mean to you? I think the common definition ends up being something like volatility. So if things are up and down, how do I feel about that? And we actually feel pretty strong that that's not the right definition of risk. The right definition of risk is not achieving your goals. What is the risk that I will not get to, retire or on time, put my kids through college, whatever those important goals are. So it's the not achieving the goal that is the risky thing. This other stuff is just, variability along the way. And if you have a good perspective on that going in, and you know how you can harness this tool called stocks to help you achieve your goals, then you should be able to stay on track with that. So the industry has really struggled with how to define risk. And then this is the really scary part. How do you put a numeric value on someone's risk tolerance? There's all this stuff out there about risk tolerance scoring and all these algorithms, and they're everywhere. You get into markets like this, you can throw those risk tolerance questionnaires out the window. They mean nothing. And I might be a bit in the minority on that opinion, but we do not use risk tolerance questionnaires and scoring mechanisms in designing portfolios at Oxford. I think it's misguided. I would say it's almost malpractice. And yet, that's probably the majority. That's the majority of advisors is exactly how they do it, because they're going at it from a mindset of, well, if I just get this score, then I can put someone in this type of portfolio, and then I'm protected, and the compliance department won't come after me. And it's unfortunately, it's a legalese way of looking at the world. We are very goal focused with our clients. What are the goals you're trying to achieve? When do you need to achieve them? And we will say, for you to achieve that goal, you've got 3 options. You can put the goal off longer, you can save more towards that goal, or you can adjust how much risk you're taking to achieve the goal. And we have what I think are pretty adult conversations with people and say, this is what it would take. Which one of these 3 things are you willing to do, or which combination of these 3 things are you willing to do to achieve your goal? And if we've done our jobs well there, we would then write the goals down. We would document what the stated plan is for achieving those goals. And then we would go and design a portfolio that would provide the return needed over some period of time to help achieve that goal. That's the right way to do it. All this risk tolerance questionnaire stuff, I think, is incredibly misguided, and we've seen it more than once that it falls apart in environments like this. I don't know if that gets to the question, but that's how we go about it.
Makes sense. Okay, next question, again, kind of getting back to this idea of stability bucket and growth bucket. I think we talked a little about what that stability bucket's for, and how we design it. Then you have the growth bucket, which has, in our case, mostly equities. So the question is, does our management or our thoughts or our theories and philosophies on how to manage the growth bucket change, during these times? So obviously, we mentioned before, we're not going to be harvesting any gains in the growth bucket because it's just not an appropriate time to do that. Is it still okay to rebalance the growth bucket? Should our thoughts on how to make changes in the growth bucket change at all, given times of more increased volatility?
Yeah, that's a good question. Broadly speaking, you've got 3 things you can invest in: stocks, bonds, cash. There's other stuff out there, different twists and combinations with hedge funds and private equity and all this other garbage. It's stocks, bonds, or cash. And in our parlance, cash would be a stability bucket item. So I don't really call that an investment so much. It's an important part of the portfolio, but it serves a very different purpose. So with the part of the portfolio that I would say is available for growth, you're talking about stocks and bonds. And within stocks and bonds, there's different variations in there too, but I always think about growth being one of three numbers: 12, 10, and 6. And like, what the heck is he talking about? Those are the long-term returns of the major asset classes that you can put in the growth bucket. 12% is the return on small company stocks. 10% is the return on large company stocks. And I'm blending domestic and international together in that number. And 6 is the return on bonds. Take your pick. Some combination of those three things over time will get you somewhere. Now, if what your goal is to, I want to, rapidly grow the portfolio because I'm trying to get there for retirement, and then, in retirement, I've got this standard of living that demands a certain type of return. I would argue that bonds probably don't fit that need very well, because the other piece of what I just said, 12, 10, and 6, those are pretty easy to follow. There's one other number you've got to put beside those, and that number is 3. 3 is a negative number. That is what inflation has historically run at in this country. And so, those first returns I gave you were the returns before inflation. You can subtract 3 from those. Now you're down to 12 minus 3, that's 9. 10 minus 3 is 7, and 6 minus 3 is 3. Bonds are only going to provide real growth of about 3% a year, which is, not that impressive. That's really not that much better than, just general housing. So really, that's a tool that's in the arsenal there. But some combination of those three things are the things you have to, available to you. Should you make any changes within the growth bucket in times like these? We're, at least from our portfolio design, we're always taking a look at those major asset classes and saying, should it be 24% large U.S. value right now or 28%? But those are calls that we make in a very disciplined fashion prior to the beginning of the year. And we go into the calendar year with a plan for what those weights should be. And again, those are based on taking very long-term views of relative valuations of domestic stocks versus international, large versus small. We will always hold some combination of those things. We're not going to dance in and out and try to say, well, this is the hot asset class this coming year, let's go over to that. That's market timing. That's chasing returns. That is another thing that leads to, unfortunately, a lot of poor results in clients' portfolios. We don't do those things.
All right. Since it came up there as kind of stocks, bonds, cash, we did have a question. You can speak a little bit about bonds and kind of your thoughts on where we are in bonds with the crazy interest rate environment, even before, some of the more recent stuff. But the question was, I don't only want to get into total cash, but shouldn't I would it be a wise idea to move some of my stocks to bonds to theoretically take, quote unquote, less risk?
Again, there's that risk word again. It is very much a question of what does your plan call for? So we don't view the stock market as some big casino where, hey, let's roll the dice and let's place a bet on red 24 because I think that's really going to be the thing this year. We look at what the client's hoping to achieve, and we do that in a very written way, so we know what those goals are, and we have an adult conversation about it. And then we look at what the portfolio design would need to be over the long haul to achieve those goals. For us and for the types of clients we have, they have these long-range goals, such as, I'm going to retire at this age, and I'm probably going to have a 30 or 40-year retirement. That's an incredibly long time. We know that inflation is the biggest risk that person faces. It's not volatility day to day, month to month. It's inflation. Inflation will eat you alive in retirement. It's not discussed all that much, particularly since inflation's been, historically speaking, rather tame here for the last decade. But if anyone's been around since the 1980s, inflation actually can be a really bad thing. It can really destroy asset values over time. And so if we know that someone's got that long of a horizon, we would document that there's probably a very appropriate place for stocks to play a strong role in that portfolio. We may have some bonds in the mix to help support that, but we would not look at, gee, this just happened in the market. Shouldn't we go over here to avoid risk? I will tell you that bonds are a ticking time bomb right now. And I'm not trying to make that much of a market call, but when rates go down as low as they have, they generally speaking only have one direction to go, and that's up. And there's an inverse relationship between interest rates and bond prices. And I'll make it as simple as this. If you go out today and try to buy a 10-year treasury from the US government, it is absolutely safe. You will get your money back, and you'll get whatever interest rate is associated with that bond. I don't know what the 10-year treasury is at right now. I mean, it had gone down to some ridiculous number recently. It's might be hovering around 1 right now. Let's just say that it's 2. It's not that high. Let's just say it's 2. So you could buy a 10-year treasury right now, and you can put $1,000 in. You'll absolutely guarantee get your $1,000 back in 10 years, and you'll get your 2% interest. But if inflation is at 3%, the only thing that we've done here is we've guaranteed that you're going to lose money over time. You're going to lose purchasing power by investing in this. To me, that looks really risky. Why would I sign up to intentionally lose value? So the inflation thing cannot be ignored. Plus, you got taxes on top of that. But we'll leave those out of the picture. So, running to the asset class that so far this year has actually generated positive returns in the rearview mirror seems to me to be not a very smart strategy. So we have, just generally speaking, in portfolio design at Oxford, we're not big users of bonds at all. But because we have the stability bucket that provides a lot of support for people's spending needs, and then we're, in our growth bucket, we're pretty heavily invested in stocks at all times. We believe that is the right long-term thing to do to help support our clients' long-term goals. And we document that with the client. We have a good conversation about it, and we all say, yep, let's do this. David, don't think bonds are risk-free. I think there's some bad news coming for bonds here in the coming time, but we'll see what happens.
Okay. Just want to take a quick break for everybody real quick, just to let you know we got about 15 minutes left before we're going to wrap up. So we do have several questions to get through. I only actually have a few more left on my list of ones that were pre-submitted. So just a nice way of saying if you have something you want to get out there and get off your chest, put it in the chat box now, and we'll make sure to try to cover it here in the last 15 minutes or so.
And we may have covered this. I apologize if we did not. Anything that we don't get to, again, this whole session is recorded, and that includes us being able to see all of the questions that have been submitted. We will go through and kind of check these off and say, did we address this one? If we did not, what we'll do is we'll do a write-up. Give us an early next week probably, but we'll do a write-up that addresses those questions, and we will send that out to all participants so you guys have that.
We'd actually have, just as a quick follow-up to the last point, and maybe we might do this as a follow-up to this person offline, but someone had asked to explain a little further, not too much detail, but a little further why bonds are a ticking time bomb.
It depends on what type of bond you're talking about. Obviously, U.S. Treasuries, they're not going anywhere. Those are guaranteed. I'm just saying you're guaranteed to lose purchasing power. So to me, that's very risky. I don't look at the stock market over, well, here's just facts. The facts of the matter are there has never, ever been a 15-year period in the stock market where you would have lost money being 100% in stocks at all times. We would never advise a client to go that far out, but those are just the facts. If you look at 10-year periods, they've only been 2 times. And I think, what is it now, Pat? 75 out of 77? Is that the?
77 out of 79.
Yeah, I'm behind. So out of 79 tries, only 2 times would you have actually had not made money on stocks over 10-year periods. So I look at over the appropriate horizons, I don't think stocks look that risky. U.S. Treasuries, you're really not going to make anything on those, but at least your money will be sitting there for you. And they're an appropriate tool to use inside something like a stability bucket. As you go out the spectrum, look at longer-term treasuries, and then you start looking at corporates, then you start looking at munis, and you start looking at high-yield bonds. Those are all very different things. We've used some high-yield bonds in the growth bucket because they perform, quite frankly, they perform a little bit more like stocks. It's just that their way of generating income is more income-focused instead of total return-focused. So wherever you are on that risk spectrum probably changes the answer to the question a little bit. Munis are funded largely by tax receipts. And if people aren't out working, spending money, shopping, paying tolls on roads, if they're not out doing those things, where's the money going to come from to pay for those munis? Even though they look like they're AAA and safe, we've already been down that road more than once, and AAA bonds can fail. And so munis might be a place that I'm not sure why you take the chance with it. You're really not getting much return, and you've got some downside risk with them. There's no guarantee that these things actually will pay, even with when they're backed by credit agencies. So that's something to take into consideration. And as you go farther out on the curve, corporates, we've been doing a lot of talking about which industries are going to be forever changed because of what we saw here. And I mean this in a positive way. So Groceries. Most places are still allowing you to go out and buy groceries, and that's great. But some people don't want to go out and buy groceries. They don't want to take the chance of being exposed. I think I just looked at this morning, that the penetration in the United States of home delivery of groceries was only about 3% going into this. I can assure you that coming out of this, that number will jump up and people will never go back to the old ways. So, Kroger bonds, are those a good investment right now? I don't know. I imagine Kroger's going to close some stores after this thing is all said and done, because people got used to shopping a different way. And stores are expensive. That real estate's expensive. Rent is a big deal. Amazon does not have to worry about the rent costs. They have warehouses and they have an unbelievable distribution network. So, something as seemingly safe as a Kroger bond, one of the largest companies in the United States, maybe isn't so safe.
All right. Last couple questions. Someone asked, how do you guys determine, how much you should have in stability? I know that 5 is preached, but I have 2 right now. Is that okay?
I think again, it's a question of time horizon. We do have some clients who we sit down, we have a nice adult conversation. They say, gee, I hear what you're saying, but I don't think I need to have quite that much instability. And we have had good conversations about that. And we agree to modify their investment plan, and we write it down and we present it to them and say, okay, well, here's what 3 years of stability looks like. Do you want us to do this for you? And we move forward. And so I think it's a very specific question in each person's case.
Agreed. Makes sense. Next question, again, put your crystal ball hat on for a second. I don't know how much we could say on this, but 2 questions related to just kind of the recovery of the market, if and when that'll happen. So it says, what are your thoughts on market recovery, timing, and/or strength? And then I've read the word dead cat bounce. What the heck does that even mean?
I'm not sure who coined the dead cat bounce thing. I actually have a cat in my household now, which I swore would never happen, but my daughter talked us into it, and he's actually a pretty cool cat. But anyway, I'm getting off the topic here. Again, that 08 and 09 period was really interesting because the number of times, and I could share my screen, but I don't want to bore you guys with all the numbers on it. The market peaked in October of 2007. By September of 2008, the housing market stuff was already out there. I'm like, oh my gosh, what's going on? And then Lehman Brothers goes out of business September of 2008. Pretty shocking. That was tens of thousands of jobs that were just eviscerated. Congress didn't step in the bailout, so a lot of lessons were learned from that. And if you look at the pattern of what happened back then, September was obviously bad. We were down 20% plus in a very short period of time. But there were rescue packages, some of what we're talking about now. In October, actually saw some strengthening. And even by early November of that year, of 08, you could have easily made the case then, like, hey, I think we're done. We're past this thing. And then, bam, we got hit with more stuff. A lot of things internationally were falling apart, and some of the stability programs from central banks overseas weren't working very well. So it went way back down again by the end of November, and it was pretty scary. But I'm talking about 20% swings on the way up and on the way down in a period of a couple or 3 weeks. And then we got to January of 09, and it looked like, it's a new year. We had fresh perspective. It looked like we turned the corner. And even at that time, I remember people saying, hey, I want to put some money to work. I think we're good now, right? And then March 9th of 09 hit, and people were just absolutely, at that point, we had gone down 57% from the market high back in 2007. And that was the point where people said, that's it, I give up. I'm done. And and I'm saying that just as a general statement about investor sentiment in the economy, not specifically talking about our clients. But that, I think people had thought we were off the dead cat bounce a couple of different times, and this one really, really rocked people back to the point where even as the market went screaming up starting the next day, the media, supposed experts were all denying that this could possibly be happening. Don't get fooled by it. This isn't real. It's a dead cat bounce. And all the market did was go up 30% in the next couple of weeks. So, and people denied it and wrote all kinds of stories that couldn't possibly be true. So I think it's a good market timing story. That's kind of where the dead cat bounce thing has been used a little bit. And I think if you back to an earlier question, if you have truly free capital to do something with, it's not committed somewhere else you might not need, buying something at 30% off, there's a decent argument you'll probably do pretty well doing that. but understand that you may have some more pain before you see the full, the full reward from putting those dollars to work.
Next question is a person who's retired, and they said, I was taking an appropriate amount out of my portfolio, given what I had. Is it time to consider taking out less now? I could live off less if I needed to. I just want to make sure I have enough to last in my lifetime.
Yeah, this question came up a lot, even amongst our own clients back in 2008, 2009. And we've just, I've seen different advisors handle this in different ways. Some of them have some really sophisticated systems for saying, if the market has been doing something, this return for this amount of time, then you are free to take a raise over what kind of your budgeted spend. Go take more, it'll be fine. And then, but if the market starts, goes down this much for this long, well, then we want to pull that back and have you take a pay cut. And that pay cut may even be lower than the budget, line you were on before. And I've talked to some of those people and shared a lot of notes about how they're managing that and kind of comparing that to our philosophies. I think that's a difficult thing to do. And so we've always managed our retired clients with an idea of, hey, the number that we run, that we calculate for you and send to you, we want you to know that that is absolutely solid. That if the market goes way up, you don't necessarily need to go start spending more, but if the market goes way down, we would never call you up and say, oh my gosh, you really should, you should cut back. That's just not a comfortable thing to have to do. You kind of manage your lifestyle to a particular number. And once you're there, that's probably the right number for you. And as time goes by, if we have several years where the market's been really strong, we'll sometimes have conversations with clients and say, hey, I don't want to raise my baseline number, but I got to replace the car, it's getting old, and can I just take a one-time withdrawal for that? And we'll do things like that rather than constantly adjusting the paycheck, so to speak. So there is no need amongst our client base to have to take a pay cut, but some people will say, I'm going to take a pay cut because I actually want to have the opportunity to put more dollars to work. That could be a strategy. Okay,
I got about 5 minutes left before we wrap up. So the last question we have, and some of our current clients know this, but the 5 words of wisdom, which is what we have in our philosophy, is it's never different this time. Some of the virus, even back in 2018 when we had a market drop, there really wasn't anything. It was 20%, but there really wasn't anything to point to. Obviously, 2008, 2009, September 11th, there was some kind of event. Now there is something to point to with the virus, and certainly I think the healthcare aspect of it, or people getting sick, adds an extra element to it. So we know that here at Oxford, we feel it's never different this time, but what gives you confidence that it's not ever different this time, despite that it might feel that way?
I'm a big fan of history, big fan of data, and I'm also a big fan of just, I'm generally an optimistic person, but not in a, I guess I'd say I'm a rationally optimistic person. If you look at the long sweep of history and you look at, gosh, I just drew a blank on what the name of this website was. Well, anyway, I'll get back to it. There's a book on my shelf and I'm thinking about pulling down. I just put it up in front of the screen. I just can't find it. And look, human ingenuity is an amazing thing. And it is absolutely factually true that worldwide, this is the best it has ever been. More people lifted out of poverty than any time in recorded history. I mean, it would just go on and on. So I'm not someone who can very easily find the negative in what's going on out there. I'm so fascinated by the positives that we see all the time, even with setbacks like this. And we literally have, actually one of our clients, literally one of their kids is one of those researchers right now who's at the lab at 1 o'clock in the morning trying to figure out how to beat this thing. And they're, it's one really smart kid working along, my goodness, probably thousands of other people in the biotech pharmaceutical industries. They're going to solve this thing. And so I'm telling that story because it's all of those little efforts and advances that are being made that collectively allow us to look at something like, gee, how can you be so confident the stock's going to return 10%? It's different this time. It's not. It's not different this time. And then again, 5 words of wisdom is what we call them. It's never different this time. The facts of why we're in a mess in a particular time, that's a different story than the one that happened before and the one that happened before that and the one that's going to come next. But the underlying strength of human ingenuity, an unbelievable economic system that allows people to be rewarded for taking risks and trying to put new things out there, that's where you get 10% returns over time. And you either look at the sum total of our efforts and say, my goodness, the future is bright, even though we're going through a cloudy period right now. Or you look at it and say, it's different. I'm just not comfortable. And that's okay. If that's your feeling, then you should not be in stocks. I mean, it's as simple as that. But if you do believe that the long view of this is that things are going to be better, then stocks are a way to be rewarded for helping invest in those advancements that are taking place right now. I mean, we have clients who are invested in pharmaceutical stocks. I don't know which one of them will end up doing really well out of this thing, but you're making an investment into the future of really human success. And that's how I feel about that stuff.
All right, great answer, and I absolutely totally agree. I got about 5 minutes left, so Eric, if you want to do a brief wrap up, and I can talk about some of the logistical follow-ups, but I'm going to put a bow on today's conversation.
Yeah, I alluded to one of them, actually a couple of things. There might be 3 things that we might have as follow-up. So one, to the extent we didn't get to your question, we will go through every question that was submitted, and we'll do a write-up. I don't know that we'll repeat the ones that we covered today, Pat. What do you think?
We might do it just as a reference, just in case someone needs a follow-up. But yeah, we'll definitely focus on the ones that we didn't get to. Actually, there's very few of those that we didn't get to. So
if there are new questions that we can group together, we'll tackle those and we'll send something out. Secondly, we did mention that this is all being recorded, so you can back and you can watch this. We'll make that available to folks. We're doing a lot of writing these days to try to stay in communication with our clients and some other folks that we've talked with over time. And so there is a piece coming out Monday that some of you are probably even already on the distribution list for, that talks a little bit more about where we think things are going from here and why we're hopeful for the future. I think the third category of things, there may be something that if you're listening out there, you may have had a very specific question that we couldn't really address very well here, or you may have had a question that you didn't feel comfortable putting out in a public forum. That's very understandable. If you'd like to talk privately about something that's going on in your situation, we'll make available a link to a scheduling tool that we have, and Pat will have some more details on that in follow-ups. But just know that we've got that on offer as well. And of course, it is social distancing friendly, so we can do a phone call or we can do one of these video chats just like this. I'm starting to really like the video thing anymore. But of course, no in-office meetings because we've been working remotely for the past week. We kind of got kicked out of our office building, so that's how we get those things done.
all right, yeah. So just a quick follow-up. You mentioned that make a link available. So as part of the follow-up to this meeting next week, actually a couple things. Later today, you'll get a survey. Just letting know about your experience today. If there's something that we didn't cover that you'd like us to, just help us improve for future possible events. Next week, we'll be sending out a follow-up email with those questions that Eric mentioned, cover everything that we covered today, make sure we get to any questions that we didn't get to. And within that, there'll be a very big button on there that says, schedule an appointment with the Oxford team. So if you have a more specific question, something a little more personal that you didn't feel like sharing today, by all means, click on that and get on our calendars, and we'll be sure to make time to address that with you. Don't have any other questions, so I think that's it for today. All right.
Thank you all very much. Appreciate the questions.
Yeah, thank you all for being here. And if you need anything else, just let us know, and appreciate everybody being on the call. Thanks so much.
Wash your hands.
That too. All right, bye everybody.